Welcome back to Father and Son Investing. In yesterday's video, we discussed Warren Buffett's plan for his wife's money after his passing. He indicated that he had advised the trustee to put 90% of the money into an S&P 500 index fund and 10% of the money into short-term U.S. government treasuries. Now, there are a number of S&P 500 index funds out there. The question for today's video is, are these all the same? And if not, which one might be the best one to be investing in now? So let's get started. Let's just move to the first question. Are all S&P 500 ETFs the same? And the answer is no. They can differ by strategy. Some of them just use the core S&P 500, while others might use different ways, such as equal weighting, or there's even an S&P 500 ETF out there that tries to short the S&P 500. They can differ by net assets. You'll see here that SPY has the largest amount of assets, and you'll see that the ProShares short S&P 500 has the smallest amount, at least on this list. Now, I have gone ahead and narrowed this list down to some of the S&P 500 ETFs that I like. We've got 5 of them here: the Vanguard S&P 500, the Spider. There is actually another Spider ETF, S&P 500 ETF, that people might not know as well, and that goes by the ticker symbol SPLG. We've also got the iShares, IVV, and an equal weight ETF in here, the Invesco S&P 500, goes by the ticker symbol RSP. Before we move on, let's just talk about the difference between these ETFs then. The top 4 on this list are core ETFs, meaning they just have the S&P 500 in there, and they are weighted according to market cap. Let's just discuss quickly about the difference between these. So SPY, VOO, IVV, SPLG, they're all using the core S&P 500 as their ETF holdings, and those are weighted by market cap, meaning if a company is worth more, its market cap is worth more, it has a larger percentage within these ETFs. So you'll see here that Microsoft makes up 7.3% of the SPY, and similarly Apple is really close there at 7.28%. In fact, the top 10 holdings make up almost 1/3 of the total assets within those 4 ETFs. Now, the other ETF that I mentioned, RSP, is weighted differently. It has equal weighting, such that every company within the S&P 500 gets an equal weight within its ETF. What does that do? It exposes you to a lot more of the smaller companies or the lower cap companies within the S&P 500. Now, that's just one way that they differ. Let's talk about another important way that they differ, and that has to do with the expense ratio. In fact, the ETF among these that has the largest assets under management, that would be SPY, the Spider S&P 500 ETF Trust, expense ratio 0.09%. Now, that doesn't sound like much, but let's look at the other ETFs here and their expense ratios, and we'll see that we're looking at 0.03% or 0.02%. So a third, or even less than a third, of what the SPY costs. I'm using the Charles Schwab investment fee calculator site here because it allows us to compare various investment fees and see the effect of those investment fees on our investing. I've gone ahead and taken the average S&P 500 return over the past 30 years. That happens to be 9.9%. And we'll just calculate what happens when we employ various fees here. We've got the 0.02% for SPLG and RSP. We've got the 0.03% for IVV and VOO. And then we've got the 0.09% for SPY, that Spider S&P 500 ETF Trust. Calculating that out in this scenario, you'll find that the difference isn't that much. It's $16,000 for the 0.02% fees versus the 0.09% fee. But let's just change this just a little bit. Let's say instead you're starting with $100,000, and let's see how that works out. And the difference now becomes $45,000. Now that seems like a significant amount to me. In fact, $16,000 seems like a significant amount to me. So just this little difference in fees over 30 years can add up to something significant. At today's prices, potentially a car. In 30 years, that might buy a bicycle. Now, in many ways, we're going to find that these don't differ much. In fact, when we look at the asset allocation They're almost exactly the same. The only difference here is for RSP, which has a little bit more of non-US equity. And again, that's because it's an equal weighted fund versus the others, which are all market cap weighted. And this graph here reflects that. We'll see that 4 of these companies look almost exactly the same. And RSP is the one that looks different here. And again, that's because it is market cap weighted. In fact, you'll see that the majority of RSP really is in that mid cap range. Now, if you're buying the 4 market cap weighted ETFs, you're going to find that Infotech is going to be by far the largest share of the pie when it comes to investing in those ETFs. If you are investing in RSP, you're going to find that industrials are going to have the largest share of the pie, with financial services coming in a close second. When it comes to their returns are going to look very similar. In fact, this shows you the returns from December of 2005 up to November 30th of 2023. And it's really difficult to figure out the difference between any of these following along this black line, which is the benchmark, because 4 of these are essentially following that benchmark and their returns are very similar. You'll find, though, that RSP at times is actually returning better than the S&P 500 benchmark, and at times the returns are less. When it comes to the recent yields, you'll find that RSP has been doing a little better than its competitors. The SEC yield, so that's for the last 30 days, essentially 1.87%, and the 12-month yield 1.72%. Here's just a quick picture for you of how each of these have done year by year. If you're interested, you can stop the video here and take a look. And this is just a quick comparison for you during times of market declines, during market stress, how each of these have compared. And again, you can stop the video and take a look. This is a comparison for you of how these have done during times of US stock market gains. The one that I find the most interesting here is as the recession ended, look at how well RSP had done compared to those 4 core S&P 500 ETFs. However, here's one that you'll be interested in since interest rates are currently falling. And what you'll notice here is that for most of these, RSP, that equal weighted ETF, performs less well than the other 4 core S&P 500 ETFs. So after all of this discussion, how would I rank these S&P 500 ETFs in terms of my interest in purchasing them? Well, starting at number 5, the one that I'm least interested in is SPY. I see no reason to pay 0.09% when you can get essentially the same thing for 0.03% from either Vanguard or iShares. Number 4 on my list, I think I would put in there RSP. I like RSP in terms of its equal weight, but there is a little bit more risk involved there because the companies in there are a little bit smaller. Nevertheless, it is attractive at its 0.02% fee. Now, number 3 for me, I'm going to go ahead and put the iShares ETF in here, the IVV. And that's just because I am less knowledgeable about iShares than Vanguard. And so my number 2 choice here is going to be the Vanguard S&P 500 Core ETF, and that goes again by the ticker symbol VOO. Vanguard is an excellent company to be invested with, although their customer service has gotten a little poorer in recent years. Nevertheless, an excellent company still to be invested with, and fantastic when it comes to investing fees. The number 1 that I'm going to take then is SPLG at its slightly lower fee, 0.02%, and there's actually one other reason why I like this particular ETF. That particular reason is its share price. It's only $55.93 as of today. That pales in comparison to those other core S&P 500 ETFs, which are well over $400 per share. So if you don't have $400 to spend on a share of any of those either ETFs, you can go ahead and use your $55.93 to buy a share of SPLG. However, please realize that the SPLG's assets under management are far less, as you can see here, than the assets under management for the other 4 ETFs. Nevertheless, I think that there are still enough assets under management to make it liquid enough if you need to sell. In fact, in recent days, the trading volume of SPLG has been very similar to the trading volume for VOO. Now, some of you out there may not be convinced that the S&P 500 is the way to go if you're the average investor, and you may prefer investing with a financial advisor. However, let me just show you this as a way to hopefully change your mind. In a one-year period, about 39% of funds will beat the S&P 500. That's in a one-year period. However, when we start to increase over time, you'll notice that the number of funds beating the S&P 500 decrease over time, such that in 5 years, it's only about 13% that are beating the S&P 500. In 10 years, it's only about 14% still. But in 15 years, you're looking at only about 8% of funds out there that are beating the S&P 500. So you have a 92% chance of making more money by investing in the S&P 500 than letting somebody put you into other funds. I hope this information was helpful for you. If it was, please give us a thumbs up and share this kind of information with someone else, particularly a young person in your life. And as always, until next time, enjoy your investing.